friends, my name is Luann Schulfer. Welcome to the Schulfer and Associates Wealth Management presentation of the 2026 Economic and Market Outlook based on information from the LPL Financial Research team of experts. First, I'm going to take a few minutes to remind you a little bit about who we are as a firm. Then we'll take a look back over what our 2025 forecast was, what were our hits and what were our misses. And then Jim Robinson and Jean Schulfer, who are also wealth management advisors with our firm, will join me to present to you our 2026 outlook, where we will discuss our views of what the economy and markets may bring forth for investors. Jim will recap our presentation and he will leave you with some important reminders. Schulfer and Associates Wealth Management is a boutique independent firm offering white glove service to our clients. We are located in beautiful downtown Stevens Point, Wisconsin, and have clients throughout the United States. Independence means that we are not employees of another firm like a bank, an insurance company, or like a wirehouse advisor would be. That means that we are not subject to corporate quotas, we do not have a bias toward any particular investment or company, and no canned corporate mission statements. Rather, independence means that we can truly act in a fiduciary capacity, doing what is in the best interest of our clients rather than serving a corporate culture. Great resources such as technology security, specialized teams and resources, and of course, LPL's highly reputable research team. In a nutshell, Schulfer and Associates Wealth Management is a team of 7 experienced advisors and support staff with the resources of LPL. And we create lifetime relationships with our clients and their families to help them through important decisions as they arise, with financial and retirement planning, and of course, with investment management. That's the part we're going to focus on today, the management of money. Let's take a look back at 2025. About a year ago, we delivered a similar outlook forecast. Without a crystal ball, we had both hits and misses. Our hits. In equities, we stayed fully invested. That was a hit. If you remember back to the spring of last year, when many others were terrified from tariffs, we remained bullish and we stayed the stock course. While many others were also concerned about market concentration during 2025, with massive concentrations of the mega cap tech stocks, we stuck to our equities. Staying positive on industrials and negative energy in the first half was also a hit for the year, as was an overweight to communication services. In early July, our 2025 mid-year outlook, we raised our target to a range of 6,000 to 6,100 with a bull case scenario of 6,450. That was not high enough as the S&P ended 2025 at 68.45, 1.2% below its record high closing on December 24th. In fixed income, our hits included favoring mortgage-backed securities over corporate bonds, and another hit was pushing back against the narrative that U.S. exceptionalism was fading and that Treasury securities were losing their safe haven status. In reality, the U.S. fixed income markets outperform most developed non-U.S. markets, with the Bloomberg Treasury Index making its best year since 2020. That was a hit. Our miss in fixed income was avoiding emerging market debt. We considered EM debt as an attractive opportunity, but ultimately we decided to avoid it because of the idiosyncratic risks of the index spanning over 70 different countries. As for our 2025 economic forecast, we correctly stated and communicated regularly that tariffs would not automatically turn into higher inflation. We were accurate in our predictions that the Fed would cut rates several times, but missed on the expectation that economic growth would decelerate later in the year of 2025. We are pleased to report more hits than misses last year, and a successful year was had. Now, let's move forward and dive into 2026. And at this point, what we believe the markets and the economy are likely to bring forth for investors. Outlook 2026 is titled The Policy Engine, as government policy decisions are shaping direction. Things like new tax provisions, government spending and fiscal stimulus, regulatory shifts, and Federal Reserve interest rate movements. And sometimes the more things change, the more they stay the same. While the US economy could be sluggish in the first half of 2026, it is also expected to avoid a full-blown recession. This is due to the tailwinds of easing monetary policy and the business-friendly dynamics that come within the One Big Beautiful Bill Act, which was passed on July 4th of 2025. The lagged effects from a slowing job market, from softer wage growth, and some nagging inflation will dampen growth in the first quarter of 2026. But as businesses and households regain their footing from uncertainties during 2025, we expect 2026 to grow close to 2.1%, higher than 2025, but not as fast as 2024. Mortgage rates are primarily influenced by long-term interest rate dynamics. Those long-term interest rate dynamics are shaped by the fiscal outlook and the 10-year US Treasury yield, rather than just the Federal Reserve's short-term policy rate. So, when fiscal policy results in large deficits and heavy Treasury issuance, investors often require higher yields to compensate for increased supply and inflation risk, pushing mortgage rates higher. But 2026 should be a year of declining mortgage rates, creating some opportunity for home buyers and for the housing market. Geopolitical and trade uncertainty will stunt the Eurozone's economic growth. High relative energy costs, coupled with some broader structural weaknesses in productivity and in technological capacity, ends up limiting the Eurozone's international competitiveness. And ultimately, this risks growth below United States levels. Plus, many members of the Eurozone are implementing fiscal tightening measures, which will act as a drag on their growth. Japan's goal of the virtuous cycle of sustainable inflation driven by robust wage growth looks more likely to play out in 2027 rather than in 2026. The nagging questions for investors are the pace of future rate hikes in Japan and the timing of the terminal rate, which is complicated by ongoing global economic uncertainty and that government's desire to support growth. I'm going to hand it over to Jim to talk about stocks and midterm elections. I'll see you back in a few minutes to talk bonds.
Hi there, I'm Jim Robinson, and it's my job to talk to you about stocks and the midterm elections. So let's move on first to stocks. A strong 2025 does not mean this advance in the stock market won't deliver more gains for investors in 2026. Several powerful cycles should help push stocks higher in 2026, most notably the AI investment cycle that's powered technology stocks in 2025. A maturing advance during a Fed rate cutting cycle with stocks nearing all-time highs also bodes well for a rewarding 2026, especially given the economy will get a fiscal boost as stimulus from last year's bill kicks in and boosts corporate profits and cash flows. Potential AI disappointments, possible upward pressure on long-term interest rates, renewed global trade tensions, and geopolitical instability will still remain risks for stock investors to monitor. If this outlook seems familiar, it's because it resembles 2025. On October 12th, the current bull market celebrated its third anniversary, marking an impressive run since its inception in inflation-plagued 2022. The S&P 500 surged more than 80% over the first 3 years of this bull market, excluding dividends, far outpacing historical averages. If history is a guide, as this chart shows here, then this bull market may have more room to run. The S&P 500 has averaged a 12.8% gain historically during the fourth year of bull markets since 1950, with 6 positive years out of 7. Though please do note that past performance does not guarantee future results. The Fed rate cycle should provide another tailwind for stocks in 2026 as it did in 2025. If the economy holds up, rate cutting cycles tend to be followed by stock market gains. Stocks prefer rate cuts that are luxuries rather than emergencies, and we would categorize upcoming cuts as the former. The Fed is normalizing rates, not staving off an impending recession. This rate cutting cycle is unique because stocks are near all-time highs. In previous instances, when the Fed cut rates when stocks were at or near record highs, 28 cases, the S&P 500 was 13% higher on average 12 months later, with 93% of those 28 periods producing gains. When the U.S. economy was not in recession around a rate cut, the average 12-month return for the S&P 500 increased to 18%, with gains in all 21 periods. Perhaps the most powerful investment cycle affecting stocks is the wave of AI capital investment. Consensus estimates for 2026 CapEx from the 5 hyperscalers is expected to approach $520 billion, a roughly 30% increase over this year's estimate, and an estimated 1.6% of the U.S. economy measured by nominal GDP, or gross domestic product. In terms of dollars that can help drive the economy and corporate profits, nothing is bigger than AI right now and is very unlikely to change anytime soon. Let's pause a second to go over a couple of terms from that last explanation that you may not be familiar with. First is hyperscalers. Hyperscalers provide cloud computing and data management services to organizations that require vast infrastructure for large-scale data processing and storage. While there's no universal standard for what should be classified as a hyperscaler, major cloud providers such as Amazon Web Services, Google Cloud, Microsoft Azure, IBM Cloud, and Alibaba Cloud would fit that description. And the second is CapEx, which is short for capital expenditure, meaning these businesses are planning to spend money on themselves, which is typically a good sign for the economy. The AI frenzy is being reflected in analysis expectations for double-digit earnings growth for S&P 500 companies overall, both this year and next. The Magnificent Seven has been responsible for more than half of the S&P 500 earnings growth the past few quarters and will likely continue to play a significant role in growing earnings in 2026. While the wide gap between Magnificent Seven's earnings growth and the rest of the market will likely persist well into 2026, supporting large-cap growth stocks, expect this gap to narrow as the year progresses. This is something to watch closely when the calendar turns, as it could spark a market rotation into value stocks. Developed international equities have been attractively valued for a long time and remain so. But a repeat of the strong currency-driven performance in 2025 seems unlikely next year for 2 primary reasons. First, international equities, particularly in Europe, lack the dynamic, tech-fueled growth of the U.S. economy. That shows up in earnings growth expectations, where we expect the U.S. to generate 50% more earnings growth in 2026 than developed international. Second, a repeat of this year's big move down in the U.S. dollar is unlikely, putting international and U.S. equities on more even footing. Bottom line, international equities may keep up with the U.S. because of the still wide valuation gap near 30%, but the U.S. economy and corporate America deserve a sizable premium. Our view of emerging market EM equities is similar. Okay, now that takes care of stocks. Let's move on to what we're looking at for the midterm elections. The midterm elections introduced a fresh layer of uncertainty around the future political makeup of Congress. In 2026, all 435 seats in the House of Representatives and 1/3 of the Senate's 100 seats will be contested. The outcome of these elections could have far-reaching implications for federal regulations, fiscal policy, taxation, and broader economic initiatives. They will also serve as a key referendum on President Trump's political agenda. The Republican majority in the House is razor-thin, as they hold just 219 seats, one more than the 218 needed for control. This represents the slimmest margin since 1931 and significantly increases the risk of a shift in power next fall. In 20 of the last 23 midterm elections, the president's party has lost seats in the House, with an average decline of 27 seats. Historically, midterms have been challenging for equities or stocks. Since 1950, the S&P 500 has averaged a modest 4.6% gain during midterm years, with an average maximum drawdown of 17.5%, making it the most volatile and weakest performing year in the four-year presidential cycle. Once political uncertainty subsides, markets tend to rebound. In fact, the S&P 500 has posted an average gain of 14.5% in the last 12 months following midterm elections, and has finished higher every time over the last 75 years, although past performance does not guarantee future results.
All right, back to bonds, where boring is good. Hence, navigating neutral is our expectation for the year going forward. Market pricing suggests that rate cuts by the Fed could end by the second half of 2026, with a trough rate around 3%. If this market pricing is right, it's likely that the 10-year Treasury yield will remain around 4% flat. It's unlikely that the Fed will cut rates to levels that would take the 10-year Treasury much lower than that. So we think that for 2026, a range of 3.75% to 4.25% for the 10-year Treasury yield is appropriate, at least for how things are looking right now. Even with some challenges, the broader credit market is not in crisis, and we do not think we are on the cusp of systemic credit issues. Rather, our eye is on market valuations. Credit spreads, meaning the additional compensation that you would expect to get paid for owning risky debt, remains pretty tight given some rising associated risks. While yields may appear to be attractive because they're higher, the spreads remain lower than what we've seen for long-term averages, and therefore are not providing sufficient compensation, in our opinion, to take on these emerging credit risks. It's always fun to look at how interest rate scenarios can hypothetically affect bond returns. Take a look at this chart, for example, showing how a change in interest rates from a range of rates falling by a percentage point to a range of rates rising by a percentage point affects various bond indices. Our belief is that agency mortgage-backed securities and investment-grade corporate bonds should outperform Treasury securities given the higher starting yields for both asset classes. As the Fed continues to cut short-term interest rates, you'll see cash yields coming down as well, meaning you'll see things like CD rates and money market rates decline. And with rates going down in the cash markets, this should allow high-quality fixed income markets to outperform cash holdings, which makes the case for investors leaving their cash assets behind to allocate to high-quality fixed income. Thanks for hanging with me. Now I'm going to turn it over to Gene.
Hello, I'm Gene Schulfer, and I'm going to cover some additional areas that we're watching that may impact our clients' portfolios over the next year. Mergers and acquisitions, or M&A activity, has been trending up both in terms of the number of deals and value of the deals, supported by the deregulatory policies, rate cuts, and increased demand in AI-related transactions. The US dollar index is a measure of the value of the US dollar relative to a basket of major foreign currencies, including the euro, the Japanese yen, the British pound, the Canadian dollar, the Swedish krona, and the Swiss franc. Despite recent volatility, the dollar's long-term uptrend remains intact. The 2025 drawdown found support from a secular trend dating all the way back to 2011. To break the long-term uptrend, the dollar would need to fall below the September lows near 96 that would likely signal a new bear market cycle, shifting from consolidation to a resumed downtrend. Key downside risks for 2026 include escalating trade tensions, a weakening U.S. economy, and capital rotation into outperforming international markets. The Bloomberg Commodity Index is a broad, rules-based benchmark designed to measure the performance of the global commodity market. It is made up of 23 separate commodities in 6 major sector groups, including energy, grains, softs or non-grain agriculture, livestock, industrial metals, and precious metals. Any weakening in the dollar would provide a tailwind for commodities. Stimulus from the One Big Beautiful Bill Act and a possible recovery in China could further boost demand. Trade policy remains a wild card. Additionally, the green energy transition and surging investment in AI infrastructure are expected to drive sustained demand for several commodities. The main headwinds right now may be a continued bear market in oil. Strong performance in the price of gold in 2025 was driven by the uncertainty of the Liberation Day tariff announcements and increased fiscal deficit concerns after the passage of the One Big Beautiful Bill Act. The trend of increased global central bank purchases that began after the Russian invasion of Ukraine in 2022 is not showing any significant signs of slowing. As always, we will collaborate with our partners at LPL Research and other investment companies to position our clients' portfolios for these complex and ever-changing times. Thank you.
Well, that was a lot to digest. Let's sum up the 4 major categories that we talked about. The economy. The U.S. economy is expected to experience a modest slowdown in early 2026 before rebounding later in the year. Underlying resilience from AI-driven investment and fiscal spending should help offset weaker household activity and steer the economy clear of a recession. We anticipate the Fed will proceed with rate cuts gradually in 2026, balancing inflation concerns with a softening labor market. For stocks, the bull market appears poised to extend its run in 2026, fueled by an ongoing enthusiasm around AI and further easing of monetary policy from the Fed. However, with valuations running high and midterm elections often bringing more volatility, gains may be more tempered in 2026. Maintain current allocations, stay diversified, and stay patient for pullbacks to potentially increase equity exposure, or buy in the dip. For bonds continue to offer compelling income opportunities, with 10-year Treasury yields anticipated to remain between 3.75 and 4.25%. Investors should focus on income generation rather than price appreciation. And as the Fed lowers short-term interest rates, returns on cash will continue to decline, making high-quality bonds with intermediate-term maturities more attractive for long-term investors. And finally, portfolios. Given an overall investment environment that is subject to rapid change, we continue to favor balance and diversification across asset classes and regions. Stay alert during any periods of market turbulence in order to take advantage of corrections in equities. Looks like that about wraps things up. Thank you so much for watching. I would like to reaffirm that if you are not on our email list for our newsletter, please do call us. It's a weekly newsletter that includes articles from Luann, videos from myself, LPL's weekly commentary, and then updates on what we're doing or events that we may be having. In addition, please go to our website. There's a lot of good content there. I'm showing a QR code right now, so either go to www.schulferassociates.com or get your camera out and focus on the QR code. That'll take you right there. We all appreciate the opportunity to work with you and to take the journeys with you. And I would just suggest, if you've watched this far, hang in there past the credits. We've got a few treats for you at the end. Thank you.
Bring that there.
Slide 20, mergers and acquisitions.
And you can keep the video rolling.
Try it again.
Mergers and acquisitions, or M&A activity, has been trending up in both
LPL for their great many resources. Start that back again. Sorry, I said it backwards.
I don't like that at all.
Sorry, Jim. The thing blanked out on me. Okay.
Ready?
You're good. Ready.
One more time. In previous instances,
I feel like if you just put it way to the bottom a little more. No, other way.
Oh.
The we are filled with.
but please do, but I need to zoom this in.
Take a look at this chart showing how a change in interest rates, back that up, we'll start that part over.
Perhaps the most powerful investment cycle affecting stocks is the wave of AI capital investment. Consistent.
That's it.
Wow.